Retailers sell down Telstra as half-year profit falls. Registering interest, retail stocks recover slightly, but is it time to take on Myer? And buyers at work, the share market rises as the unemployment rate unexpectedly falls. Hello, I'm Richard Goncalves. Welcome to the Thursday edition of Market Moves. Today's star performer on the 200 is Codeco, and the day's dog, Telstra, shares down by 5%. Roger Montgomery from rogermontgomery.com joined us now to tell us exactly what moved the markets. Maybe we should remind people that you're independent now?
Yeah, I've been watching your Facebook page and I notice there's a few people who still think I'm associated with the funds management business that I started, but I've sold that and I resigned last year, so I'm not part of that operation anymore, completely independent.
And if people are wondering what do you mean Facebook page, just search Market Moves in the Facebook search engine, join.
Great page.
Fantastic. That's enough plugs. The market bounced back today.
Sure.
Why so, do you think?
Yeah, well, look, I've always said this to you, Richard, and I'll say it again. I don't think the daily moves matter that much. What's really interesting is, despite the sell-off that we've had, and and the last time I was on the program, I said I thought the market was a bit expensive. It's down. I think since I said that, it's down about 8%, 7.5%, 8% since then. So I'm not saying that to tap myself on the shoulder and say, well done. I still think the market's a bit expensive. So even though it bounced today a little bit, tomorrow it could be down a lot. I just don't know. No one can predict this sort of thing. But I do know that most of the companies I look at, and we'll go through some of those today, some of the better quality businesses are still expensive.
I know you've got your own valuation methods in terms of valuing stocks, but if we talk about the macro environment right now, and it seems that one of the main reasons why the share market fell lately was because of these concerns out of Europe, right, in terms of debt. Is it a major concern, or do you think it's been blown out of proportion? No,
look, I think any stable, or what is perceived to be a stable economy, if they're going to default on debt, that's a major trauma and a major shock, irrespective of the size of the country, and so. It's really important, though, to understand that despite that being true, you and I and everybody watching the program tonight are making investments in a micro sense. We're buying businesses. We're buying the Reject Shop or JB Hi-Fi, Woolies or Myer, whatever it is that we're going to talk about tonight. And really, whether Greece defaults on its debt or not is not going to affect how many $2 products or tubes of toothpaste the Reject Shop sells. And so therefore we need to think in terms of, and this is a common mistake, we make these micro type investments, but we make those investments based on macro thought, and I think that's an error. What we need to do is we need to think about the business and not worry too much about whether Greece is going to default. Given that the market is expensive though, it's worth keeping that in mind.
Okay. Before we move on, let's take a quick check of the top 10 stocks for 2010 so far. Okay, I know you don't necessarily... Go on.
I want to say, that's a classic example. The top 10 movers for the year so far, people are looking at that screen. I saw Channel 10 there up 5% for the year, and I'm sure people are thinking, gee, if only I could have owned those ones. Channel 10 is, in my mind, ridiculously expensive.
Right.
It's so far above its intrinsic value, it's just unjustified. And that's always been the case. For media stocks in Australia, for most of them. They seem to be the playthings of the rich and famous, so their prices are at levels that aren't justified by their performance. Yet it was up 5% this year. It's been an outperforming stock. I don't think that really matters, and I think over long periods of time, a year, 2 years, 3 years, 4 years, you'll find that the performance of those businesses, performance of the shares is more likely to reflect the performance of the business.
I'm always pleased when the graphics does the talking because I don't need to ask the question, but that's why we put that up there for some debate. But while we go from that, let's talk about retailers right now. Shares in JB Hi-Fi are slowly recovering after being sold off earlier this week. That was after its 29% rise in first half profit, and on the announcement its CEO was stepping down. JB shares fell from $20.10 to $19.07 on Monday following the news, but they've doubled during 2009. Meanwhile, Myer shares have bounced back this week from its all-time low on Monday of $3.14. The stock has been in free fall ever since its listing late last year with an IPO price of $4.10. Lots to talk about here, and it's something that you've been commenting on quite a bit. First of all, Myer, did you see its share price fall ever since its listing? Was it something coming?
Well, I said it on your program. You know, that when it listed at $4.10, I think I told everyone in no uncertain terms, steer clear. My valuation was between $270 and $290, and at the most optimistic. So $4.10, you know, in my mind was not a great investment opportunity. And yet, at its lows recently, $1.8 billion was lost after it floated. And I can't find a broker who said sell when it listed. You know, most of them were positive in their recommendations. So what that tells me is, the question is, what about now?
Yep.
Well,
so right now it's at $3.36.
Okay, at $3.36, it's still above its intrinsic value. As I said, I think $270 to $290 is what it's worth. I like to buy things below what they're actually worth, and so that opportunity isn't there. And when I analyse what I think the business is going to do over the next 5 years, I come up with a valuation of $3.90. So if you were to buy the shares today at $3.30 odd, and it's going to be, the value will be $3.90 in 5 years' time, well, the return is less than what you'd get in a bank account.
Okay.
So you're probably better off in a bank account, given that it's guaranteed and it's safer.
What I find interesting, though, is back in late December, early January, we started getting all these brokers upgrading the stock, or at least saying buy, buy, buy. Yet it happened at the same time when the share price was falling, so no one was really buying it. So is it purely, without being too judgmental on what these instos are doing, are they just purely trying to offload the stock now?
No, I'm not sure that it's that. My concern is that, like an amateur investor, even the professionals make their decisions based on price action. So that they see the price going down. Well, I recommended it as a buy at $4.10. I better recommend it as a buy at $3.60. I've got to save face. At $3.60, it's a lot cheaper than it was when I first recommended it. People are ringing me and saying, well, you know, I'm pretending to be an analyst here. You know, the brokers are all ringing me from upstairs, and they're all saying, look, you recommended this thing at $4.10. It's a dog. It's down at $3.60. What now? Well, it's a strong buy. You know, it was a buy before. It's a strong buy now. And that might be a face-saving exercise. Something isn't cheaper because its price falls. It's cheap when its price is less than its value, and at the moment, it hasn't even got there yet.
Okay, and very quickly on JB Hi-Fi, what's your take? We saw its share price fall dramatically, even though profits came in at 29%, but the CEO stepping down. Look,
I think every one of your viewers would know that all last year I was suggesting that it was my number one pick. I'd bought it at $8.50. It had been $23. At $23, as I said to you, it was a little bit dear compared to its intrinsic value. Its intrinsic value was about $20 at the time. This recent result, there was an interesting thing in the result. And it is the increase in the payout ratio. So more dividends are being paid. Now, you might think, and most people might think, that's a good thing. That's a great thing.
Yep.
It actually means the company's worth less now.
Okay.
Why? Because it's not keeping as much money in its bank account and earning 45%. It's getting a 45% return on equity. I would love that it keeps all the money, but it's not able to do that now. And so as a result, it's starting to pay a little bit more out.
So that would be... playing devil's advocate, that would be better for a longer-term investor, not someone that necessarily wants to take instead of someone taking the profits out now. Yeah,
no, I agree with that. It just means, what it means though, Richard, means you pay a different price for it. You know, given that it's now paying 60% of its earnings out as a dividend, it's retaining less to earn 45%. Return on equity, and so as a result, it's worth a little bit less. In fact, I've got the valuations here, which I'm sure you were looking forward to.
Go for it.
Yep. So previously I had a valuation of about $20.30, and the valuation now is about $19.30. My valuation for 2011 is about $23. And the 2012 is about $26 or $27. They're all down a few dollars from what they were before the result.
And the current share price right now, $19.55.
Yeah, so look, it's right on its value today. The safest thing to do is to buy a discount to the valuation, and it's not there. It's just on the value. We'd like to buy it at a discount, but it's still going to give you, even if you bought it today and everything happens according to plan, and Richard's retirement wasn't according to plan, but if everything happened according to plan, then you're still getting about a 15% return over the next 2 years based on the increase in the value from the current price. that's a lot better than everything else that's out there. It's certainly better than Myer.